Hello and welcome to yet another Value Podcast. I'm your host, Andrew Walker, and with me today, I'm excited to have the founder of The Bear Cave, Edwin Dorsey. So Edwin, how's it going?
It's going great, Andrew. Thanks so much for having me on. I'm excited to be here.
Hey, well, I'm excited to have you. You know, you're unique for this podcast because first, I think you're the first guest younger than me that we're going to have. So you're starting to make me kind of feel my age. But second, most of the guests have been long focused, and you're, I would say, more short focused. So I think it should be a really interesting conversation. And let me just pivot that into the way I start every podcast, and that's by pitching you. You've been doing the Bear Cave newsletter for what I would say about 6 months now. Has it been longer than that?
Yeah, maybe 6 or 7 months.
Yeah. And it's great. Again, it's unique. There isn't a lot out there that's short focused. And I've just loved it because every time a big short report comes out, it can be tough to grab it. You always grab it. You always have an interesting angle on it. And you've just recently pivoted to, you're doing kind of your own unique alpha identifying opportunities. So the first one was great. I'm really excited for that. I've really enjoyed the product and really enjoyed your writing over the past couple months. So, that out the way, give us a little background on yourself and how you came to start the Bear Cave.
Okay, Andrew, I'm 22. I've always been really passionate about stocks from a really young age. Like in second grade, I was talking about stocks. Freshman year in college, I got hooked into the short side because by coincidence, I met two great short sellers, Mark Cajotes, who's kind of on Twitter, and Jim Carruthers, who runs a short-only hedge fund. And I worked for him on and off for 3 years, and that's kind of how I learned the ropes of the short side. I also interned for the SEC enforcement division, so I got to see the other side of how companies are regulated and the shenanigans they do. So I've always been really passionate about the short research and finding fraud. So about 6 months ago, like you mentioned, I started this free newsletter where I would talk about recent activist short campaigns. And more recently, I rolled out a paid version where twice a month I highlight companies with unnoticed problems that I don't think are being picked up by the market.
Yeah.
So that's kind of neat.
And let me dive right in there because I think people are going to hear you're 22, and I know a lot of people will be like, "Oh, turn it off. This guy doesn't know what he's doing." But I think you published the first one. It's free. It's on Celsius Holdings, and whether you like the idea or don't like the idea, like I think there are a lot of unique angles. And I think back to Mike from Non-Gap when I have him on, and he reads a proxy statement. And he pulls out things and angles that no one sees or expects or thinks of. And like when you pull out this Celsius report, you're going to see stuff that it's equivalent to the stuff you'd expect to see in Muddy Waters is probably the most famous activist short seller out there. Like there's those angles where you're pulling out, hey, this person 4 years ago worked at this fraudulent firm and now they're on this board. Like, isn't that a red flag? And all this sort of stuff. So I just wanted to, just highlight that for you, but please go ahead.
To talk about Celsius?
Let's talk about Celsius later. Let's dive into Bear Cave a little further, actually.
Okay.
So Bear Cave, first of all, disclaimer, nothing here is investment advice. Especially shorting can be extremely risky. But that out the way, let's discuss short selling. Just give us a basic overview of what short selling is.
So short selling is a way to bet against a company. The mechanics are pretty simple. You find somebody who owns a stock that you want to bet against. You're going to bet that it goes lower. So you borrow a share of stock from somebody at its current price. You pay them a small fee for the inconvenience. You sell it and you say, I'm going to return this share to you at a later date. So the person basically has a fake synthetic share. You take the real share, sell it on the market, and then you buy it back at a later date. And if you sell it at 100 and buy it back at 80 to return it to the original person, you make a profit. Now, if the stock goes up and you sell it 100 and you need to buy it back at 200, you can have a big loss. In fact, the losses can go to infinity. But that's basically the mechanics of short selling. It tends to be really tough to make money on the short side. So if you look at like Jim Chanos, his short only book, I think, since inception 40 years ago has maybe annualized 1 or 2% positive returns. So it's really tough to do a portfolio of shorts well. But the one nice thing about it is it can allow you to get more long. So if you have a short book that's breaking even, then you can go more long the stocks you love. And that's how you really generate big returns.
Yeah. So I think you answered my next question, why would someone want to short sell? Because over time stocks go up and you're kind of betting against the trend. And your hope is your hope is everything you short goes to zero, and you sold it for 100, it goes to zero, and you never have to pay them back anything. But your real thought here is, and correct me if I'm wrong, hey, because I'm going short some companies that I think will go up less than the overall market, I can be going more long the overall market because I've almost got this hedge in place.
That's precisely it. So what Jim Chanos does, and he's probably close to the best out there, if not the best, is he is like 190% long stocks and then 90% short. So it's just like, net 100% long, but if he can break even on the shorts, then he's going to get twice the market return on the long side.
Perfect.
So, and I think he's annualized something like, I'm guessing here, but 18 or 20% a year over 30 years, which is insane.
But I guess the next question would be, if you're a talented short seller, right, you can go out there and you can actively identify stocks that will go up less than the market. The question is, hey, why can't you use that skill set to identify stocks that will go up more than the market? And shouldn't you spend more time focusing on that? Because, over time, because returns compound, if you're getting long stocks that go up more than the market, like that's going to make a lot more money than stocks that go up less than the market.
That's a great question, Andrew. And Andrew, I think it's really two different skill sets. It's like saying, if you're really great at soccer, why not play basketball? Because basketball players earn more. It's like, to me, it's very different ball games. Like for short selling, for me, it's a lot about digging. So looking into management history, looking at old documents, filing a lot of FOIA requests, trying to figure out if there's something fraudulent or scamming going on in the customer value proposition, and reading all these comment letters and lawsuits and trying to figure out if the dirt there is actually a big problem or a small problem. On the long side, I think it's really different. It's you're gauging customer satisfaction. You're trying to predict new product rollouts. There's similar stuff, but for me, shorts and longs are just two different ball games.
Okay, no, that's great. So it sounds like you're more focused on short selling. Are you solely focused on that, or do you look for longs as well?
I would say 90% of my time is shorts. With longs, I do a little bit of stuff on the microcap side. Usually if I make a long investment, it's more shoot from the hip than actually well researched. But 90% of my time researching stocks is on shorts, and I can spend hundreds of hours researching a single idea on the short side. On the long side, I'll never spend more than 5 or 10.
Okay. No, I'm just going back to what you said, where the skill set for shorts and longs is so different. Like, since launch, I've been running my fund for, I guess, about 5 years now. And that's exactly what I found. Like when I'm looking for something that's long and looking for something that's short, like long, I'm looking for something that's undervalued where I like the management. With a short, my initial thought was, oh, you just find something overvalued where you don't like the management. And actually that doesn't really work. Like I think valuation shorts tend to be the worst shorts, where you say, I think this is worth 20 times. I'm going to short it because it's at 25 and it's got a worse. Like you really want something that's got a lot of hair and a lot of red flags with some combustible risk. And I just find the skill sets for long and shorts just really aren't compatible, to be honest with you. So I kind of think you hit the nail on the head there. Let's go into your process a little bit. You're focused 90% of your time focused on short selling. I wouldn't be surprised. You said you're 22, but I wouldn't be surprised if that's going to leave you with some gray hairs in the near future. How do you generate new short ideas?
Okay, so one way is just by talking to people. You can talk to other people in the industry. I'm also always talking to just young people I meet, and people I meet, like, have you heard of any companies that are scamming or bad? That's my favorite way, but that's tough. One thing I do is I read every single comment letter the SEC sends companies. So
okay.
People that don't know, comment letters are letters that the SEC sends publicly traded companies, kind of scrutinizing their financials. They get public after a month delay, and you can find them just on Edgar or on the full text search tool that they recently released. And there might be like 10 or 15 new ones posted every day. A lot of them aren't serious, but if you read through 100 of them every week or so, you'll find like 1 or 2 where the SEC is just like flaming a company, do 10 different bullet points on things they're getting wrong in their filings. And the cool thing is you get to see the company's responses. Usually a company has about a month to respond. And sometimes the companies will have a really good response that makes the SEC just look wrong, or, it will have a substantive response. Other times the companies will respond being like, you're wrong about this. We're sorry. We're changing our policy. We're changing these 6 things. And it's like, what's going on? And the nice thing about comment letters is I really don't think enough people are looking at them. So I think it's one thing that kind of gets underpriced or mispriced, especially because there's a month delay. So it's like not the type of short-term, like trade right now thing Wall Street loves. So I look a ton at comment letters. I do run like screens sometimes, not in the typical way. Like I got a list in Excel of all 6,000 publicly traded companies and their auditors. And I kind of looked for huge companies that weren't using a Big Four auditor, because there's probably a reason why. Or, Grant Thornton and BDO are kind of number 5 and 6, still have credibility. But what are the $1 or $2 billion companies that aren't using like a credible auditor at all? So that's another way I find ideas. I think Twitter is also a really underutilized resource. I think Twitter is a great way to find ideas too.
Let me dive in. I want to talk about comment letters in a second, but let's start from the end and go backwards. So Twitter, I agree though. We can talk about Twitter later, but let's talk about the looking at companies with different auditors, right? Kind of, let's say outside of the big 6. So one thing I've struggled with is sometimes I'll look at a company and it's a $5 billion market cap company, and they'll have Dorsey Walker is their auditor firm, and we'll be a $5 billion company. There are auditors and they don't audit anyone else over 50 million, right? And I'll look at that. That's a red flag, right?
Yeah.
Well, a lot of times you talk to the management team and they say, oh, we'll upgrade at some point, but we've had explosive growth recently, right? We grew from a $75 million company 3 years ago to $5 billion, and we just haven't changed. And I never know, like, is that a reasonable thing? Because switching an auditor takes some time, it takes some headache, it's going to spend a little bit of money. Is that a reasonable thing, or do you think like the moment you can kind of afford it, you should just go with Big 4, Big 6, or whatever? How do you think about that?
So I would say you can see when they got the auditor. Did they get it 6 years ago when they were actually a smaller company and they've actually exploded since then? Or at the time they chose their auditor, were they also kind of misplaced in choosing an auditor that was much smaller than they should have gotten 6 years ago? The PCAOB database lets you see the specific audit partner at a firm that's auditing a company. Most people don't know that. So you can actually see which audit partner is. And I have a theory, you can see like audit partners who are bad tend to like audit other fraudulent or bad companies. So the audit partner has a history of like auditing companies that get fined or like go bankrupt, and that's not a good sign. So I think there could be, especially in the smaller cap space, some credibility to that argument that we've outgrown it. But I think more often than not, they're just saying that to kind of mess with you. You can also, look at executive turnover. So if you've had 3 CFOs in the last 5 years, that's probably a sign like there's actually gamesmanship going on. But if you've had the same CFO, you had an audit firm that was appropriate for where you were 2 years ago, and you just happened to grow a lot, I might give you a little bit of credibility there.
Yep. And let's go. The first thing you mentioned was SEC comment letters, right? And
yeah.
I think this is such a great tool because, look, I follow every firm that I follow or invest in, anything. I've got alerts set up all across the board, right? And as I think about it, I think a lot of the alerts that I've set up don't even pay attention to or pick up on SEC comment letters. So, I think that's such a good one where I do agree with you. I think it's very under noticed and under followed. Like I can't think of a single person who I've been talking to been like, oh, did you see this SEC comment letter on their revenue recognition? But B, just to dive more specifically in it, what's something in particular in the comment letter that you're looking for where you see it in an outsider might say, oh, that's a normal revenue recognition thing. But to you say, oh my God, the SEC is really, really piling on this company here.
So one really bad sign is if the SEC sends multiple, so the SEC will send a letter.
Yep.
Sometimes it can be as simple as one question. Other times you can see it be 12 bullet points. Like the longer, the worse it is. The company gets an opportunity to respond. In 90% of cases, I'm estimating here, that ends the process and it's done. In 10% of cases, the SEC will send follow-up questions or 2 more follow-up letters, like explain this part, explain. So, if the first answer isn't satisfactory, that's a pretty good sign. Something's like the SEC is definitely scrutinizing it for a reason. That's a sign that something can be wrong. I'll also try to understand in plain English, like what they're saying. I think it was Muddy Waters talked about, I forget the company, but the company got a revenue recognition comment letter from the SEC, and the response was literally 2,000 words. And it's like, come on, I can't understand this, and you're doing it intentionally, so no one can understand it. So generally, the length of the comment letter, what's being asked about, sometimes it's somewhat small things like, we noticed on your website you have a distributor based in Syria, and the company's like, oh, that was an error. It's less than $10,000 of sales, and our web team just forgot to update it. So that's not a huge issue. But if it's like this revenue thing, this revenue thing, this revenue thing, your disclosure is wrong, inconsistent filings, please resolve this inconsistency, and the company just admits to being wrong on all that, that's not a good sign.
And you mentioned, you just mentioned they might say, hey, you mentioned on your website you have a distributor in Syria, right? Yeah. How much of my thought was the SEC enforcement division, when they were looking at these, they were only reading the 10K and kind of going with letter of the law accounting stuff, right? Like, hey, you mentioned your revenue recognition policy is 45 days. Why isn't it 30 days or 25 or something? But are they actually going out and doing some type of like due diligence, whether it's just looking at the company's website or other things when they're performing these, sending out these letters?
My basic understanding, and this is my basic understanding from the outside, no special knowledge, is about 90% of the SEC stuff comes externally. So it can be through the tips, complaints, and referrals inbox at like where anyone can submit a complaint. It can be through whistleblower reports, which get taken very seriously. It can be through referrals from the regulators or FINRA. And I think they definitely do like projects in-house too to find companies that are wrong. But I think a lot comes through external referrals, and then a lot is the tone at the top. So if the chairman wants and the commissioners want to go after cryptocurrency was a big thing, then those companies will receive a lot of extra scrutiny.
Yep.
But I do think it's a little more than just reading the filings.
So as a short, obviously you're just getting the short newsletter started up, but are you submitting complaints to the SEC, and are you seeing like, hey, this company's revenue recognition policy I don't think is right, and 4 months later, sometimes you'll see a comment from that?
So maybe not a comment letter, but I have seen things where I or someone I know, people in the short community, will send something to the SEC, and then maybe like 6 months later, the company will put out an 8K changing an investor metric or updating their investor slide. Maybe a comment letter would be a little extreme. But I have seen responsiveness from companies, and either coincidentally or not, after complaints from short sellers. And it's becoming, I think, more and more common. Like in the China stuff, I think the SEC sent out a letter to a Chinese company like the week after Muddy Waters or Wolfpack Research put out a report. And it's like, I think they genuinely value short sellers and are responsive to it.
And then, I think a big piece of short ideas is, again, it's not the valuation, it's the people behind it. It's the management teams. How much of your ideas is tracking, hey, last year I followed this company that was a fraud and their management team, and now their CFO is over here. Like, how much is tracking management teams from one company to the other? And how do you kind of structure and process that?
So some people are outstanding at that. So John Hempton, I think, has a database of 20,000 people.
He's apparently the gold standard of anyone who's ever committed fraud. He's got you in a database. The moment you pop up, boom, he's got you.
So Hempton's the king at that. I actually kind of don't do that. I usually start by finding a company that I think is interesting, and then I'll look into the management team. And people also would say, if you read the management bios, sometimes those will be misleading or leave out important things. So then you can Google them and maybe look at old articles. One of my favorite things to do, and for me the easiest, is just take a CEO or CFO's name, put it in quotes, and then the SEC has this new tool they actually recently rolled out called full text search, where you can search every SEC filing ever in the last 20 years for a specific phrase or name and see every time it's appeared. And then that's how I'll go. So find a shady company, then look at the management, put their name in quotes, put it in the full text search tool, and see every time their name has appeared. So it's not just where they've been an official board member, but anytime they've appeared as an investor, anytime their name was mentioned in a competing filing. And then you're going to get a bunch of these filings, and you can just look through them and see, okay, this is every time this person's name has been mentioned in an SEC filing for the last 20 years. You do that for the board and executive team. And then you I think that picks up on about everything.
And let's talk a little bit more about short selling. So one thing I worry about with short selling, right? When I think of this year, or just everything outside of investing, I worry that we're increasingly in a post-truth world. You know, like I think of something like Hertz filing for bankruptcy earlier this summer and them saying our equity is worthless. They don't even get an equity committee appointed in the bankruptcy. And day traders take the stock from, 60 cents to $5 in a month, and just this frenzy of retail stock trading. And Hertz was actually going to use their stocks to fund the bankruptcy before the SEC shut it down. But, I think of something like that, or I think of Tesla. I think short sellers have lost more money on Tesla than any company in history, right? And when I look at all the claims that Elon made, you mentioned turnover in the C-suite. Tesla had so much turnover in the C-suite. I think Elon said 100,000 robo-taxis on the road by the end of 2020. I guess he's still got 2 months to deliver on that, but we're not getting 100,000 fully autonomous vehicles. And I just that's the type of promise. It used to be like, if you clearly made a promise that ridiculous, like your stock would get hammered, but that stock is up, 5x over the past year. And I just see Tesla, Hertz, things like this. And I wonder, are we past the point of short selling? Because you can kind of just hype a company to the point where your stock will go up, and short sellers will blow up. You short a company at 1% position, you think it's going to zero because it's worthless, like Hertz. It goes up 6x. It doesn't take too many of those to just blow a short book up completely.
Yeah, so I have two general rule of thumbs now. One, don't short these small cap things below 500 million or even below $1 billion, because there's so many of these companies Workhorse, I think an electric truck company, up from 1 to 20, something like that. There's so many of these small cap things. I think especially with these Robinhood and chat rooms and options, just and all this stuff, that these names can explode on nothing and be completely worthless and still get out of this world. So you just don't want to be shorted, because you don't want to be blown up 10x on anything. And then Tesla is a great example of a big company that really went against you. So my second rule is I really try to avoid names that are crowded on the short side. People say high short interest is a good thing. High short interest companies tend to underperform. I would much rather prefer to find a great a potential short that has a low short interest than a high short interest. I think just on the long side, how there can be a lot of crowding of ideas, there can definitely be the same on the short side, and it's worse on the short side because then you can have squeezes, you could have more expensive borrows. So I've spent close to no time ever thinking about Tesla, and my view is you can much easily find a much better short in the $1 to $2 billion market cap area that's going to perform much better, or you can be the 100th person talking about Tesla. And it's if you care about the returns and playing the game and doing the research, then don't research Tesla. It's
no, look, I completely agree with you that I guess my worry has always been, even if you're in the $1 to $2 billion market cap company, it's very easy for a $1 billion company. We see it all the time now. All of a sudden they're worth 20 billion or something. And then, but with the Tesla, it was a $50 billion company. You thought, oh, they're kind of the most expensive car company in the world. And then all of a sudden it's 300 billion. So you can have your face ripped off either way. I agree with you. My favorite shorts recently have been something like AT&T, where I don't think it's as good anymore, but you looked and you were hey, this company, every strategic decision they can make, they do it poorly. If there's something for sale that's about to be a dying business, they're going to go out and overpay for it. They bought DirecTV for way too much money. The capital allocation was awful. Just everything they were going to do was awful, and I thought the business was overvalued at the time. So it's this type of sleepy, they're going to do everything poorly. It's probably overvalued, and nobody else cares or looks at it because it's not going to go to zero. That's kind of been my favorite. One more question on short selling, and then we'll move on to Celsius. I think one of the things about, especially the scammier companies, when you short them, their first response is always not defend the business, it's attack the short seller, right? Somebody came out with a short report, we're going to hit them with a lawsuit, we're going to attack their character. You're starting up a newsletter, right? So I'm sure you're going to run into this. You're doing public short selling. How are you thinking about legal risk here?
So I would say a few things. I think sometimes companies get upset if somebody's targeting them over a long period of time. I'm just doing a new company every 2 weeks. I think I'm going to be going a lot less deep than the typical activist short sellers. My first report was pretty good. I think my next one will be pretty good. I don't think all of them will be super deep or market moving. I think they'll be interesting. I think they'll provide a new perspective. I think some people will use it to eventually do research and initiate a short position. I don't think, I don't think any companies are going to be suing me. You can also kind of tell based on the companies you go after. Typically, like the much smaller ones, penny stock pump and dumps are more likely to take legal action. The bigger companies are more likely to, maybe contact you behind the scenes. But I don't think most semi-legitimate $10 billion companies are going to sue a 22-year-old. It would just be bad press. Like Care.com, the one company I wrote about that got me in a little trouble. They contacted my college to complain about me, but they never sued me. So I'm not too worried about it for now.
And Care.com, I think a lot of your points were eventually proven correct, if I remember. I mean, that was like a 2018 story, right? But I think eventually a lot of heads rolled over there.
Yeah, the CEO, CFO, general counsel, and half the board got replaced. The company was sold. And that was the one company so they sent a letter to my parents' house. They called Stanford to try to get me in trouble, and they even sent a private investigator to my house at one point, but never sued. So
that's crazy. No, it's funny. Like Care.com, just crazy story. IAC bought them for $500 million. I'm actually I know a lot of the history, but I'm actually quite bullish on them today. I don't know if you're still following them or not.
On Care.com or IAC?
Care.com.
Care.com. I've done a little, followed them loosely. Now that they aren't their own publicly traded company, I'm not following them as closely. It's weird. Like, even though my big report came out 2 years ago, I still get like journalists reaching out, like, do you know about these safety issues? Or like lawyers saying like, we're suing Care.com. Do you have anything you want to like help us with? I think it could be a really valuable business, especially during coronavirus, as long as they get the safety stuff right, or they make it clear that this is like a Craigslist for babysitters and not, a well-vetted platform. You either need to disclose the safety risks or eliminate the safety risks. Yeah. You can't have this middle ground where you make it seem safe, but it's not.
I 100% agree with all your points there. I think exactly like you said, like, I think they've got a good business. I think they've got a really nice brand name even after all that stuff. And I think like going forward post coronavirus, companies are going to be very interested in, hey, how do we provide our employees with some type of home care and stuff for their children? And Care.com is pretty much the only natural platform for that. And I just think there's a lot of optionality, but neither here nor there. Let's turn over to your first report. It's on Celsius. The ticker is CELH. I'm going to turn it over to you right after I mention one more time that nothing on this podcast is investing advice. That said, why don't you just give us an overview of Celsius and then maybe an overview of your short thesis there?
Okay, so to reiterate, nothing on this podcast is investment advice, and I'm not even shorted. So if you're shorting it based on this, you're really not doing your work. So Celsius Holdings is a $1.5 billion company that allegedly makes healthy energy drinks. So think Red Bull, but it's like healthy for you. I think a few years ago, they were claiming it had a negative amount of calories. I don't know how that's possible, but so they make these healthy energy drinks. The stock's up like 1,000% or so over the last 5 years. And their business model is they sell to distributors who then sell to end customers, generally speaking. And on one hand, they're growing really fast. They're growing like 80% a year. And there's some like legitimacy to their growth. I think their Instagram has over 100,000 followers. They're popular in the US. On the other hand, they've got a ton of these weird red flags. So the SEC has sent them multiple really scathing comment letters, in my opinion. They use an auditor that no other NYSE or NASDAQ company uses. One of their board members was Tim Leissner, who was at the heart of this Malaysian sovereign wealth fund scandal, and their head of Asia sales was Roger NG, who was also part of this scandal and is now indicted. So there's a lot of odd stuff going on too, which is kind of the crux of why I think, everything might not be what it seems to be.
No, look, and I messaged you this. One of the reasons I want to talk about this company is Celsius is a very sore point for me because last year, I remember specifically the CVS across the street from me got Celsius in it. And I love energy drinks. It's a sore point for my wife and I will be banned from them for a while, and then every now and then I can sneak one in. But I saw the Celsius and I was like, oh, this is a product that I have a lot of experience with. I saw they were publicly traded. I looked at them. I thought they were cheap, a lot of growth opportunity. But I picked up on some of the red flags that you picked on. Certainly not all of them, but the stock was at $4 then versus 20 today. So it's a very sore point. But walking me through, I think the biggest red flag to me were the auditor and the European acquisition. And I do think there's some stuff with their Asian operations as well that are pretty big, but those were the two main ones for me. So let's start with actually, we already talked about in the first part why having an auditor that no one else would have is bad. Is there anything else specifically on this auditor that you found a red flag, or is that just kind of the stuff we covered in the first part?
So some of the longs I said kind of said what you said earlier. They just outgrew their auditor. It was small, but now they're bigger. That's just not true. So they switched to this auditor, Assurance Dimensions, which only audits other OTC companies with an average market cap of about 5 million. And then Celsius is $1.5 billion company. They switched to Assurance Dimensions like 3 years ago, I believe. And at the time, 3 years ago, they were uplisting to a major exchange and they had a $200 million market cap, give or take. So they were going to be the biggest client by like a factor of 10, as far as I can tell. So at the time they chose this auditor, they were choosing an unqualified auditor. They were choosing an auditor that wasn't, like, in my opinion, suited to their needs. And now that they've grown up 10x, it's even more flagrant. But yeah, so I think, you can't just say they outgrew the auditor.
Yeah. And then the other big red flag for me, particularly when I was looking at them, was they did a stock offering. I think it was earlier this year, late last year, because their European distributor went bankrupt, unless I'm mistaken, and they bought them and they did a stock offering. And that's when I was looking at them, and it was that was the red flag for me that kind of killed it. Can you dive into what happened with the European distributor and why this is such a big red flag?
So we'll talk about Europe and we'll talk about Asia because they're very closely related. So Europe, Celsius is selling to a distributor called Funk Foods in Europe. It's a very fast growing portion of their sales. This is in like the 2017, 2018 timeframe. They actually didn't disclose the distributor by name for a while. They do this like company A, company B things. And then I think about at like October 2019, you can look at Funk Foods like website and filings. They were having a lot of solvency issues. They were like, they were doing bond restructurings. They weren't well capitalized. The Celsius distributor in Europe was having a lot of these financial issues, even though Celsius was the main product they're distributing and Celsius is supposedly really hot. And then Celsius goes and acquires them. And even though this distributor was about 14% of Celsius's revenue at the time of the acquisition, it was like 30% plus of the accounts receivable. And then it was a big portion of the accounts receivable. They acquire this company. They immediately take a big inventory write down on this acquisition. And then the European sales start exploding. So what it looks like happened is, and this is just my opinion based on the company's filings, you're selling this just no-name distributor a lot of inventory. They're accumulating this inventory and promising to pay you it at a later date. They don't pay you it because they're insolvent and can't. So then you go and acquire them and be like, oh, we recognize this revenue and it's good, but we're just going to mark this inventory down and call it a day. And oh, by the way, this distributor that we now control that's captive is buying a ton of our product, and European sales are up like 600% in the last year. And it's like, hold on, like this doesn't make sense for a lot of reasons. If you've got a hot product, why is your main distributor doing so badly? Why are you choosing a bad distributor? Why are you acquiring this distributor? It doesn't make sense. But this has happened repeatedly. So the same thing in Asia. I didn't talk about this fully in my article. They got this random Asian distributor that I'd never heard of, that I can't tell, like barely has a website. And the Asian distributor starts buying a lot of the product, doesn't pay in cash, builds up this huge multi-million-dollar accounts receivable balance, can't pay. So then they do this complex restructuring where I believe they inject cash into the Asian business and then have this weird structured royalty deal where they're getting paid on like some weird term that's defined as net revenue. There was a hedge fund involved in this process that's now suing, that's in arbitration with Celsius over how they're recognizing revenue from this Asian subsidiary. So in the filings, like now the Asian subsidiary is like, de minimis, like around 1 million, I'm guessing, in revenue. But there's a lot of questions about how it's being recognized and what's going on there. And it was previously much bigger. And they now have this like $10 million roughly defaulted or in arrears accounts receivable from the Asian subsidiary. And then for their US distributor, I didn't mention this in the article, but their US distributor, I think this is in the 2017-2018 timeframe, had a dispute with Celsius, legal dispute, and Celsius needed to pay them over $1 million in cash and stock for some disagreement with their US distributor, who I think now they use a different one. But it's like, how is it that you have got such a hot product and you're growing so fast, and then all your distributors are ending up terribly, and the person like overseeing the Asia operation is an indicted criminal? It's like, it just, none of this is making any sense. And you're using a really wacky auditor. And then another point some people have made on Twitter is they got a new management team. Well, they switched CFO, they got a new CEO in 2017, but the new CEO was the old CFO. So the CFO who was there from 2012 to 2017, who's overseeing all these issues, is now CEO. And that doesn't qualify as a new management team. So there's other issues on top of that, and you can interject if you want, or I can keep going. But they also, received multiple comment letters from the SEC, and so I'm going to read to you just a small portion of one.
Go ahead.
So the SEC comments said, we note you report a $273,000 net loss for the 6 months ended June 2015 in the statement of operations. However, you report net income rather than net loss in the same period in the statement of cash flows. Please resolve this inconsistency. And the company just said, this inconsistency noted by staff was an inadvertent error, which has been corrected. And that's like all their responses to all 10 things. It's like, you're having like a million inadvertent errors in your filings. I would just find reading the filings, there'd be typos and dates. They would not be updating info from the last year. And like, when you see just all these typos again and again and again, it's like you just lose a lot of credibility really fast in the business. They also changed the revenue recognition policy. So in 2017, they said revenue is recognized when persuasive evidence of an agreement exists, the products are delivered, sales price is fixed or determinable, and the collectability is reasonably assured. That's a pretty normal disclosure. And then in 2018, they changed it to revenue is measured as the amount of consideration the company expects to receive in exchange for transferring goods. It's like, what? So all these issues combined, when you put them together, to me suggests something really wacky is going on, and the market wasn't fully picking up on it. So that's why I put this report together, and it seems to have gotten an audience.
Yeah, no, look, those are great red flags. I guess one of the others, and this is a much softer red flag, but last month they did a deal where the company sold about $15 million or $20 million worth of shares to a growth private equity firm, which is very typical, right? Like, this is a company that's growing almost 100% per year. Selling energy drinks is not the same as selling software, right? Like, you actually need to go produce the energy drink, ship it, all that. But as part of that deal, I think like every director also sold about $20 million worth of shares to the growth equity firm. And like, there's nothing, that's not fraudulent, right? Like there's nothing wrong with insiders in the company selling, but I just can't remember any time where I've seen a company where the company and all of the insiders together sold like equal amounts of their holdings, and that worked out well. Like, to me, that's just the ultimate sign. Like, insiders are trying to get money into the company and get their money out of the company as quickly as possible, if that makes sense.
Yeah. And if you look at some of the specific board members, like Kevin Harrington, who's on the board, who's also a shark in Shark Tank on season 1, I believe he sold like 80% of his stock. So this isn't like just take a little money off the table. This is like sell the majority of your position. So there's a lot of insider sales going on there. I was going to say something, but I just, and then the other thing that makes no sense to me is these are energy drinks. This is a very high margin business. This should be so profitable to be selling these energy drinks. It should be out of this world profitable. But if you just look at the cash from operations segment of their filing, over the last 5 years, they've generated about negative $20 million in cash from operations, and they've kind of offset that with $40 million of stock issuances. So it's like people will talk about all these different financial terms and whatever, but it's like your business isn't generating cash over the last 5 years. Like quarter to quarter, it will muck around a lot because they'll be playing with the accounts receivables and stuff. But over the last 5 years, you haven't generated cash, and you've needed to issue stock to generate cash, even though you're selling this high margin energy drink. It doesn't make sense. So that it just too much is just amok there.
Yeah. Now I had a lot of, I know a lot of microcap investors who've been invested in this. Again, like it's energy drinks. It's something you can see, touch, feel. I know a lot of microcap investors who've been very successfully invested in this, and a lot of them reached out over your report. So obviously it struck something of a nerve. And I think I'll dive into some of the bull pushbacks I got, but I think the most frequent one I got was, yes, he's pointing out a lot of smoke, right? All of us could see a lot of the smoke, but he can't point to any specific fire. What would you say if I told you, hey, I get it. You're pointing smoke, but like, these are real products, right? Like I can go to the CVS across the street and buy it. I tweeted out today, if I look up energy drink on Amazon, the number 2 behind all the promotion stuff, the number 2 thing it pulls up is a Celsius energy drink. So what would you say to the bulls who are saying you're pointing out smokes, but there's no fire and you're kind of missing the forest for the trees?
Well, I would say there is a little bit of a fire. This Funk Foods thing was an absolute fire. You can't be selling a ton of inventory to a distributor, getting this huge accounts receivable balance, acquiring the distributor, then immediately marking the inventory down. You're recognizing revenue on product you didn't sell. Now, what the bulls said, or what one person said in a Twitter thread is, oh, that's a $2 million thing. That's not a huge fire. This is a $100 million a year company. You're just finding a $2 million fire. But if that's what I can find just by like looking at the filings on a weekend, then I'm sure there's more there that you're not getting. There's never one cockroach in the kitchen. Now, it's true that you can go buy the product. The product's good, and it's probably growing in the U.S. And they've definitely done a good job with the Instagram marketing and this coronavirus stuff. I would say, like, I'm sympathetic to the idea that, yeah, this company had a ton of issues pre-2017, when around 2018, they got new investors, some of this stuff started to improve maybe a little, not a lot. And now the US sales might be fully legitimate and they're growing really fast. And next year, US sales might be like $100 million and they should be trading at 20x US sales because they're going to get bought out at a huge multiple, like all these other hot energy drinks. Like, I get that. But even if you believe like none of these issues matter and the US sales are fully real, I don't think it's that cheap. Like, I think if they grow like 80% next year, they're going to be at a $100 million run rate. Maybe at the end of this year, I might have the number slightly wrong, $100 million run rate in the US, and they're a $1.6 billion company. So that's 16x revenues. And like, the sleepy energy drink companies that aren't growing get bought out at 8x revenues, 7x revenues. So it's like, it's not like this thing is super cheap anymore. It's also possible it's a fad. Like, sometimes these things get really popular and then they don't get popular. I think everybody's assuming this thing's going to be around for the long run. But part of the reason I don't think it's like an out of this world short is because I can't prove that, they're faking 30% of US sales. There is no fire, and that's the reason the stock's trading this elevated multiple. So yeah, like I can't prove that the US sales are fake. I'm not sure if I even believe the US sales are fake, but sometimes if there's so many of these issues, you can just be like, I'm staying away from this one. So I get it, but.
Yeah, I guess the other things I would say is like, in the energy drink market, and the most frequent bull pushback was, there's no fire he's pointing to. And then a lot of the bulls would say, hey, this is growing really fast in the US. Why doesn't Coke or Pepsi buy them for 10, 15 times sales? They'll cut out all the SG&A, like it'll be hugely profitable, plug them into distribution. And I get that, but like the energy drink, yes, it's a growing market, but there are a lot of brands out there. Like Coke and Pepsi both have their own energy brands. Monster's out there, Reign Energy's out there. Like there are a lot of brands. And as you said, I don't know why Celsius is like, I don't get why Celsius has any type of defendable brand moat here and what's becoming a very crowded segment.
Yeah, the thing that scares me is I always look for shorts where I could get run over. Like, I think the best performing stock over the last 20 years is the
It's
Monster
Monster.
Energy.
Yeah.
Yeah, so it's like that's another thing that kind of concerns me is let's say they have been playing fast and loose with the rules, but they have got a real product and they somehow were able to make the biggest hit energy drink and everybody just loves Celsius. It's like, wow, you can really, what if this becomes the next Monster? I don't know. It's food for thought. I mean, like, I'm personally not sure. And my report was titled Problems at Celsius Holdings. So I was just highlighting problems. I wasn't saying that, I never claimed that US revenue was fake. I was just highlighting the facts that people had missed. So yeah, I get what the bulls are saying. I don't think it makes much sense to me. Another thing that I do that I didn't include in the report is, this is going to sound a little odd. You can see what websites a company owns. There's something called a reverse who is search.
Yep.
So a who is search shows you who owns a website. A reverse who is search shows you all the websites owned by a company or an individual. So I did that for Celsius. And as far as I can tell, they haven't registered a single new web domain in the last 3 years. And for me, this has always been like a really interesting sign. Like, growing companies register new websites. It's just what you do when you grow. For whatever reasons. And Celsius isn't doing that. It's another small thing that just doesn't add up. So I can't think of any right now off the top of my head, but so many names with real products and real growth get blown up by playing accounting. Like Under Armour. Under Armour was really popular. It was a hot stock. I don't know how much it's down from its peak, but it sold off a ton, not because it's much less popular, but because it had a lot of these accounting issues and was channel stuffing. And I'm sure that if Celsius has issues, they're probably much bigger than whatever Under Armour was doing.
No, that's a great point. I think Crocs, which, Crocs is more on the fad than Under Armour side, but Crocs ran into issues with channel stuffing, if I remember correctly. And then, like some of the points you point out, like Monster was the best performing stock of the past 20 years, I believe. And if it wasn't, it was close enough that you would have been very happy to have invested in. But, like Monster, again, it was coming into the energy drink category where it was them and Red Bull, right? There was a lot of white space. Today, Celsius is coming in and there's Monster, there's Reign, there's Rockstar, there's Red Bull, there's 5 Hour Energy. Like there's it's increasingly it's an increasingly mature category, even if it's growing. There's a lot of competition there, and they're going to be fighting a lot for market share, right? So I think that's one thing. And the other thing, you spoke earlier, cash flow from operations was negative. And I've looked at Monster before, and I was thinking, oh, what were they doing? I was just kind of flipping through some 10Ks as we chatted, and they were actually, I believe they were always cash flow from operations positive, even when they were growing at really insane amounts. So I do think that does speak to another potential issue with Celsius.
Go ask your friends who own the stock why this company that sells a high margin energy drink has lost cumulatively $20 million over the last 5 years. I just want, if somebody can explain that to me in English, I would be more impressed.
Well, I don't know if that's 100% fair, because if you're growing really quickly, like it might make sense, because marketing expenses are expensed through the income statement, right? So you could lose money because you're making these huge marketing investments and you're creating this fantastic brand, fantastic moat, like you're growing quickly. And, this is why every SaaS company looks like they're losing money, because upfront they're hiring salesmen, they're growing really quickly, and they're getting people who have 4x the lifetime value of what they're spending on marketing. The thing is, for Celsius, I don't think that's quite the case, because there's a lot of other companies spending similar amounts of marketing dollars. But I could kind of see that argument.
Fair enough.
Yeah. Let's see. Anything else you want to talk about Celsius here?
There's other things I want to talk about. I don't know if I have let me just see on Celsius. No, there's not much else on Celsius. The one thing I think, if people really want to understand the company, just read the comment letters. Go to the web SEC, Edgar, look up the core SEC correspondence on Celsius, read that. And if you still love the company, great. But it's it'll take 15 minutes and it'll give you a much newer perspective.
Perfect. Well, this is great. So Bear Cave, going to do two ideas a month is the target?
Yeah, so the Bear Cave, for right now, free subscribers, they get my weekly recaps on new activist shorts. Paid subscribers will get 2 ideas every month. They'll come out on the first and third Thursday every month. It's the first one has been Celsius. I got another $1 billion company that I think has got a lot of red flags. It's being missed. That's coming out a week from Thursday. One thing that I didn't mention is I do a lot with FOIA requests. I estimate I'm about 1% of all like FOIA requests to the state attorney generals in the U.S. So
that's incredible.
You're probably going to see a lot of FOIA related stuff in the future reports. I think that's really underutilized.
That's really interesting. No, I agree. You know, we used to do several, and we don't do as much FOIA requests anymore. But I agree. Like, you can do these FOIA requests, and sometimes you can get information that is it's a lot different, or it's a lot different view than kind of what you can find publicly on the SEC website, or on the company's investor relation website, where they're never going to disclose some of that stuff to you.
Yeah.
Cool. Well, look, again, Edwin, thanks so much for coming on. I love the Bear Cave. Excited for your next report, and next time you've got an interesting one, we'll just have to have you back on, and everybody can have a Celsius and listen to the next one. So thanks again for coming on, and we'll chat soon.
Thanks so much, Andrew. Thank you.